tightening is something that I really expect. I don't see how banks ultimately go back to lending the way they did. That in and of itself is a bigger challenge for the economy. So no, I don't think it's risk on. I do think it focuses maybe investments around a greater recessionary odd where you can expect the Fed to possibly start to cut next year and, position your portfolio for those types of scenarios.
Marvin, typically then, when the curve starts to anticipate that and bull steepens in the way it has done aggressively in the last couple of weeks, where do you want to be in the equity market with that playing out?
Yeah, I still think if we are talking about a recession and we're talking about tighter credit conditions, I think you still look for stronger companies. I mean, we always want to own the best companies in our portfolio. I think quality growth has been something that I've held on to. I think financials have always been challenged with this part of the cycle, and it's a parsing of the sectors around that viewpoint.
Is the Nasdaq 100 quality growth?
You know what? For the moment it is. I think that we have the opportunity to look a little bit deeper in it and really decide which parts of that we really want. Interesting.
Marvin Loeb of State Street. Marvin, thank you. Looking ahead to the Fed tomorrow, potentially going 25. Consensus still is 25. But as Marvin pointed out, 2 weeks ago, this conversation was exceptionally different. It was 25 or 50, and maybe 50 if the data came in line with expectations, and it did. And now it's not 50, it's 25 or nothing because of the financial instability of the last couple of weeks. The Nasdaq Composite's up almost 12% year to date.
Is it because of the rate story, or is it because of the job cut story and the efficiency story that a number of these big tech companies have really put out there? I mean, I think about Amazon cutting another 9,000 employees. We talk about Apple, why they haven't done any mass layoffs, but they're doing more efficiencies and sort of trying to reduce costs. That really is the theme. And you wonder how specific, I don't want to use the I word, but specific that is to
idiosyncratic.
I didn't want to use it. Don't put that on me.
You basically did.
I didn't say it. But how much it's a specific story to the tech sector.
Do you remember the start of the year, rate cuts and recession, and then it was economic boom and monster hikes and maybe 6% on Fed funds, and now it's rate cuts and recession and throw in some bank failures. We're not even through Q1 yet.
I feel like this is like
still in the first quarter.
Narrative war stories as we try to work out just the head spinning. I do like that idea, narrative table tennis.
Where are we going to be in 2 weeks?
I mean, we'll be back where we are right now, but just, where we are going to be in between. I don't know. Let's see.
Equity futures session highs up 0.9%. Dean Mackey, chief economist at Point 72, is going to be joining us in about 18 minutes' time. Equities doing okay.
Up to date with news from around the world. With the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says the U.S. will intervene if needed to protect depositors at smaller banks. Yellen speaks to an American Bankers Association conference today. In prepared remarks, Yellen says the government's recent intervention was necessary to protect the country's banking system and that similar action could be warranted if there's a run on smaller banks. The Federal Reserve faces a tough choice at this week's meeting of policymakers. Fed Chair Jerome Powell and his colleagues will consider whether the global banking turmoil is so concerning that an interest rate hike should be abandoned. They'll announce their decision on Wednesday. The UK, Swiss, Norwegian central banks will also set their rates this week. Joe Biden has issued the first veto of his presidency. He rejected a bill that would prevent a rule allowing retirement portfolio managers to weigh environmental, social, and governance issues in their investment decisions. So-called ESG factors such as climate change have grown in popularity in finance. The U.S. will send another $350 million in aid to Ukraine's military. The package will include ammunition, riverboats, and other equipment. It's designed to keep Ukraine from running out of artillery shells and missiles to use against Russia. And the most expensive city in the world for business travel? Yes, it's still New York. According to consulting firm ECA International, it will cost you $796 a day if you're in New York for a business trip. That includes 4-star hotels, meals, taxis, drinks, and incidentals. The next 4 cities on the list: Geneva, Washington, D.C., Zurich, and San Francisco. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg. After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
I'm afraid that the regional banks in the U.S., of course, are still very, very sensitive to this crisis in confidence, frankly. The state regulators are the ones that have to be empowered, and the banks should be required to disclose more about their liquidity, their capital, their other kinds of risks, such as leverage, the concentration.
It is truly a crisis of confidence. That was Mayra Rodriguez Valadares, the managing principal at MRV Associates. Coming into today's session highs on the S&P 500 right now. Equity futures doing nicely, up 0.8% on the S&P 500. Quick snapshot of the market for you. Yields higher by 7 or 8 basis points, 356 on a 2-year, up by 15 basis points now. 4.13% going into the Fed tomorrow. The 2-day central bank meeting begins today. If you want a quick look at First Republic, FRC, that name doing okay in the pre-market, up by 23%. Not doing okay the last few days, last few weeks. Let's be clear about that. I keep saying it. Triple-digit stock 2 weeks ago, now just about double digits. Secretary Yellen of the Treasury, she'll be speaking in about an hour and 40 minutes. Here's the quote from her remarks that we're expecting for her to deliver. Our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. Lisa, as soon as that came out, we both said, is that sufficient? What's the policy backup, the follow-through that's going to come off the back of those comments?
Well, it's sufficient if you take a look at very early trading of certain bank stocks of medium-sized banks, and that's, I guess, what people are looking toward, right? I mean, you said this is basically one of the indicators that probably Federal Reserve officials are looking for today. They're parsing through the tea leaves of bank stocks.
Not the economic data, it's the bank stocks.
Exactly. So we're seeing right now, Western Alliance shares up about 7%. You're seeing PacWest also seeing a pretty big pop. So some of these other regionals that have been under pressure, getting a bit of a lift. Is it enough to be sustainable? Who knows? We don't even know what the problem is, though.
What is the problem?
It's that deposits can leave quickly and that they're invested in things that are rate sensitive and that possibly they haven't hedged sufficiently against that. So how do you solve that issue? And we don't know how deep that goes.
We don't. Does the Fed know? When they sit around the table today, do you think they know how deep this goes?
You raised the question. Didn't they have any indication of that before Fed Chair Jay Powell got before Congress and said, I don't know, 50 basis points seems like it's possible?
It's kind of remarkable that he opened the door to 50 basis points and we had bank failures 2 days later. Isn't that kind of crazy?
It raises a question of how much more intel do they actually have and how much did they understand the imminence of this kind of collapse?
That's the first question for Sri Natarajan of Bloomberg. He joins us now. What does the Fed know that that's not the first question? The United States, we understand, is actually studying the option of insuring all deposits, an emergency option. So I guess my question would be, do you have any clarity, Sri, whatsoever on what it would take to trigger that option?
So that's the important part here, the emergency option, because all the color that we are getting from our sources is right now the mood in the Biden administration, at the White House, the Treasury, everywhere else is such a measure is not required. They're hoping that the steps that they've already taken should be good enough to stabilize the market. May not be reflected in bank stocks just yet, especially the smaller bank stocks, but they're hoping that with deposit outflows moderating, stabilizing, and perhaps even reversing, they will not need to take a drastic measure. However, the importance of being able to say that they are studying this option tells you that they have not drawn a line in the sand. They are not saying that we will not go to that extreme. And that's very clear from Secretary Yellen's comments this morning, where she's pretty much taken a leaf out of Mario Draghi's playbook of whatever it takes.
Things felt bad last week, but we didn't really know the numbers around Credit Suisse, and it turned out to be 10 billion a day. 10 billion a day.
That's what people said later in the week.
Crazy. Do we have any idea what the numbers are now for some of these regional banks?
All that we've heard from a lot of these banks, everyone is acknowledging that they had seen a lot of deposit flight, but that has slowed down. We're not getting specific numbers. There is a little bit of a call for a lot more of these banks to come out and give us numbers, but it's unclear if that necessarily helps. Just look back to what happened on the day the biggest banks in the country injected $30 billion of deposits into First Republic. Everyone thought, great move, show of confidence, show of strength. Yet when First Republic came out with a statement and detailed some of the steps that they have taken in the preceding week, that did not instill confidence in the market. And that's why you have a bank stock that's now down 90% since the start of the month. And that bank might actually be the key to what next steps the government might have to take. Everyone that we have spoken with has basically said, the next few days are critical because you'll see some sort of resolution to Silicon Valley Bank, Signature Bank, but more importantly, what happens with First Republic? Is there a solution? Is there a government-backed solution, a solution without government but just private capital? Can they stabilize the situation there? That will give us a path forward.
There's a different type of regional bank from those that serve the mom and pop investors, the mom and pop shop owners in a community versus something that has much more concentrated lending in specific industries, whether it's home lending, whether it's commercial real estate, whether it's a specific type of startup. Do we have a sense of how many banks are that exposed, are that sort of dominant in specific industries?
I had a very interesting conversation with a senior banker yesterday who pointed out banks number 1 to 12 in the US, you don't have to worry about that much. Banks 300 to 600, perhaps not that much again. But it's sort of in the bank number 20 to 50, 30 to 60 is where some of the fears might be. How many news-focused, not confident enough customers exist at those banks that want to go in there, pull out their money, yank their deposit, and place it at a bigger bank? That's where the critical aspect lies. And even as we look at the landscape, it does feel, in talking to people in the industry and talking to people in government, that they are looking at a group of a few banks that perhaps still are problem children. They want to make sure that it doesn't spread to them and they don't also start to teeter and topple.
Isn't the only way that this really ends consolidation at the top? The bigger banks get bigger, that we end up seeing that kind of roll up in a massive way that will only continue?
And what an extraordinary turnaround that would be, because the standing posture for the last decade or more has been we cannot afford to have the big banks get bigger. In fact, if anything, we've seen calls to break up the big banks. They've become way too big. So if the solution from this point on is for them to get bigger, that certainly isn't something anyone would have been expecting heading into 2023.
For Bank of America, for JP Morgan, there was this hope for the big banks that ultimately this pass-through from Fed funds to deposits would happen. Do these guys need to put up rates to attract deposits when everyone's just throwing money at them right now?
I went back and looked at some of the transcripts from the earnings calls in January, some of the conference appearances from some of the senior bank executives, and there you could actually sense that they were talking about the need to fight for deposits. Bank of America in Q4 actually had seen $8 billion of deposit outflows. They said that we will have to work harder to attract deposits. Yet, when Silicon Valley Bank collapsed, in the following 3 to 4 days, Bank of America alone had $15 billion in deposit inflows. So yeah, maybe they don't have to work that hard anymore.
So what does that tell you about what profits might look like? I'm already looking ahead to earnings season for Q1 for these names. I'm sure you are too with the team. What are you thinking that's going to look like?
It's not Q1 that we're most concerned about. It's Q2, 3, and 4. Where is that net interest margin? Is there scope for expansion, or does that start to contract? That's what everyone is paying attention to, and that will be a tricky figure.
Concerned about or excited about? I think that that's the key question, because if they don't have to pay anything for their deposits and they can lend to all sorts of people who need money suddenly.
You've got to be very careful if you're excited in a moment like this one, not to sound excited in a moment like this one.
That's true. That's probably why they want to be.
Call. It's a difficult time, and then the numbers don't speak to it, and you're like, it's a difficult time. And just keep repeating this, a difficult time.
You sound jaded.
You've got full faith in the financial system.
Yeah, and they want to be the backstop for it.
Totally.
Difficult time.
We're in it together.
Yeah, exactly.
Difficult time. Sri, thank you. Good to see you. Great reporting, by the way. Fantastic. Sri Natarajan there of Bloomberg on the latest. Let's get you the latest on this market going into the opening bell about an hour and 5 minutes from now. Equity futures on the S&P 500 near session highs and elevated through the last 90 minutes or so, up by 0.8% on the S&P. Coming up in the next hour on Bloomberg TV, Matt Miskin of John Hancock, Peter Cecchini of Exonic, and Cameron Dawson of New Edge Wealth. We'll catch up with the three of them around the opening bell, Lisa, in about an hour.
And then that's on to tomorrow. Are you excited for the Fed decides?
Can't wait.
Yeah? You think it's going to be exciting? You're going to parse through the body language, how he does his hair tomorrow morning?
I don't know how you put out the summary of economic projections tomorrow in a moment like this one.
I want to see the press conference, what questions he's asked, how he reads from the document in front of him.
Lagarde was very close to the script.
Yes.
I imagine he might be too, because we know what happens when he goes off script.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back. This is Bloomberg Surveillance. John Farrow is off to his next property. Tom Keene is off on vacation. I'm here. I'm alongside Michael McKee, who's going to break down some economic data that no one's going to really look at because everyone's just watching bank stocks. And if you take a look at bank stocks, you are seeing a pop, especially after Janet Yellen's published comments that she plans to deliver around 10 a.m. today, talking about a backstop for banks, that these smaller and regional banks are important and they plan to do more. You are seeing a lift in S&P futures up 0.8%, 4,015. You could see a bit of stability across the board, if you can call it that. And frankly, I've been watching two-year yields, which have been all over the place. I mean, it really has been a bouncy ride over the past 3 months. And now we are back to the same place that we were the last time the Federal Reserve met. If you take a look at some of the banks, it is interesting to see that some of the other regionals are also seeing a pop. PacWest, we're also seeing Western Alliance getting a bit of a lift. Right now, with that economic data that you've all been on the edges of your seats for, here's our own Michael McKee.
Well, Lisa, the Philadelphia Fed non-manufacturing index, this may be the first time we ever reported it on the air. Minus 12.8, that's a decline from positive 3.2 in the month of February. Don't know exactly what it means other than service industries in the Philadelphia Fed district not doing as well as they were a month ago. But as you said, this is something that will not influence the Fed's decision tomorrow.
All right.
And nor will it into Wall Street
Okay.
because everybody's watching, as you say, bank stocks.
All right, so this is actually an important question, not necessarily about the Philadelphia Fed non-manufacturing index, which we don't really care about, although I'm sure a lot of people do care about it on the peripheries to get an understanding of different regions. Does economic data matter?
No, not to this meeting, because the data are backward looking, and the Fed is looking right now on a forward basis as what's happening with the banking system. They are looking at the incoming inflation data, of course, and that is why most economists at this point still expect a 25 basis point move, especially when we see some healing in the bank stocks. Now, obviously, they were all green in the pre-market yesterday, and then some of them finished down by the end of the day. But we have this potential rescue agreement, and obviously the Treasury Department wanted to get Yellen's comments out before the market opened because her speech isn't even until 10, but they put out that part of it that they might rescue other people because they want to give the idea that they're going to backstop and that everything's okay. And in that case, if the Fed buys that, then there's no reason they shouldn't do the 25 because the inflation problem is still there. That hasn't gone away.
Well, and that's actually the reason why, to be fair, I am looking at the 10 a.m. data on home sales and this idea of, do you start to see that ongoing rebound in the housing market on the lower mortgage rates that we've gotten, on the skittishness around the banking industry? I mean, honestly, this is very circular, but what we're seeing right now is potential resurgence in activity in areas that were the most interest rate sensitive as people price in lower rates. How much are you watching that kind of indicator to understand the momentum behind some of the economic growth?
Well, again, to repeat something we've said many, many times, this is a weird period coming out of the pandemic, and it doesn't really fit our models for what's happened in the past because real estate should be hit. But Americans are still buying houses. Builders are still putting holes in the ground out there. And as you mentioned, we've seen mortgage rates come down a little bit. If that continues, then you're going to have another question about home prices, and whether home prices start going up because there's not a lot of availability. Excuse me. This is just about to be the spring selling season.
Right.
So do people say, well, maybe I can sell my house? That's going to be an interesting open question for the Fed, because this is all going to happen at a time when we're expecting the housing part of the CPI and PCE to start to decline a little bit.
Michael McKeith, stay close. Thank you so much for that. But let's really get into how we can understand the trajectory of inflation and how big of a battle it's going to be for the Federal Reserve, even as they have an eye toward the banks. Dean Maki joining us right now, chief U.S. economist at Point72. Dean, what's your take on that? How do you understand the inflationary impulse and how much it's actually been dampened?
Well, I think the recent data have suggested that inflation is not coming down as fast as the previous data might have suggested. And this does interfere with the Fed's narrative that we're headed down in a steady way down to 3.5% on core PCE by the end of the year, and even lower after that. The recent data just don't show much slowing. And I do think that is important to the Fed's decision this week.
So what does that mean in terms of them having to raise rates by 25 basis points, and that should be digestible for the markets?
I do think it's that the Fed is likely to raise rates by 25 basis points this week. The data certainly point in that direction, whether it's the very strong employment data, the inflation data that's come out less favorable for the Fed than expected. And actually, GDP growth is picking up in the first quarter. It's not slowing down the way many had been expecting. So the economic data are telling us very clearly that the Fed should be continuing to raise rates. Now, there's other factors the Fed's worried about, but I think that's what's going to be the dominant force for the Fed. They think they have other tools to address banking system issues and problems at the banks, and that monetary policy should be aimed at getting inflation back to target.
You know, my favorite thing about this moment, Dean, is that you have 5 guests on. They all say something completely different and then say you're looking at the wrong data. And some people will come on and they'll say, okay, sure, that backward-looking data shows resilience and a sense of inflation that hasn't died down nearly enough. And other people say, yeah, you got to keep looking at that because it's been right. So where do you sort of make the argument that you have to consider this data that may be backward-looking but really gives you some clean sense of where we are now?
Well, I think the data tells us where we were coming into this past 2 weeks. And where we were is an economy that was growing at a pretty strong rate, the unemployment rate very low, and inflation way above what the Fed wants it to be. Now, the Fed has to think about, does the last 2 weeks' events mean that the data don't matter anymore? I think it's too strong to say that. I think the Fed will be thinking about how much credit tightening is going to be happening as a result of the problems at the banks. But unless the Fed is convinced that there's going to be a sudden and severe stop in credit, that means no further rate hikes are required, I think the Fed will go ahead with their steady rate hikes this week.
Some people argue that de facto there will be a credit tightening by some of these medium-sized banks that are going to restrict who they loan to and how much they lend. You make an argument that doesn't necessarily mean some sort of sudden curtailing of economic activity. Can you elaborate on why that's an important realization to inform what the Fed has to do and respond?
Well, I think, one has to think about what's happening at the banks. The very large banks don't seem to be having a problem with extending credit at this time, at least in a way that would cause a sudden stop in credit. There is credit tightening in general going on like there usually is in a Fed tightening cycle. At small and medium-sized banks, the real question is, does the typical small and medium-sized bank out there have a severe deposit outflow right now that's going to cause them to say, we're not making more loans at all? That would be what a severe and sudden stop in credit would look like. And that would, in a sense, cause the Fed to immediately stop tightening if that became apparent. My perception, from various things is that that's not happening right now. It certainly is happening at some of the troubled banks, but most medium and small-sized banks do not have severe deposit outflow problems right now. And therefore, they are likely to continue to make some credit available to businesses and households. If that's right, then there is more of a gradual credit tightening process underway rather than a severe and sudden stop.
So how far away are we from going back to a no landing discussion or going back to this idea that we could just softly glide path lower regardless of some of the recent troubles that we've seen at banks?
I think that's something that we'll be sorting out in the coming weeks. If I'm right that this is more of a gradual credit tightening process, then the very strong economic data that we've been seeing does continue to matter. And this will be a headwind against that strength in the data. And I do think there are some forces pushing the economy forward that are underappreciated, like the continued normalization of the service sector, which continues to add jobs at a tremendous pace every month. And also, I think the strength of the consumer matters here as well. If those matter in terms of the momentum of the economy, the credit tightening is pushing against that. And what we'll be trying to do is weigh those two opposing forces going forward.
So what do you make of this narrative table tennis, as James Athey put it? I mean, what do you make of this idea that people are just basically turning themselves in circles, trying to understand the moment-to-moment gyrations in a market that is more volatile than it's been for decades?
I mean, to me, it just reflects the difficulty of the situation. We're dealing with an unknowable amount of financial stress. How bad is it going to get in the next 2 weeks? How bad is the credit tightening that results from this financial stress going to be? These are very difficult things, and markets are struggling to figure it out. So we all have our own individual views on things, but the market's kind of bouncing back and forth, trying to figure out which narrative is correct.
One of the biggest issues, Dean, and I'd love to get your thoughts before we have to go, about the longer-term trajectory of inflation. This question of, are we heading back to a 2% inflation kind of reality, which is really what the market is pricing in if you take a look at the 5- and 10-year inflation expectations? Or are we heading into something where this Federal Reserve will tolerate a much higher pace of inflation to avoid some of the disruptions that we've seen in the banking sector?
I mean, I think that's one of the reasons why this week will be an important signal from the Fed. If the Fed is actually putting inflation front and center, I think it is important for them to continue to tighten conditions and signal that that is our main focus at this point. If the Fed does seem to be distracted and focused more on other issues than inflation, then I do think this impression that the Fed is going to allow inflation to persistently run above target will gain traction.
Dean Maki of Point72, thank you so much. Really important point there, especially given that so far inflation expectations have remained pretty contained. There has not been this runaway fear that people refer back to from the 1970s. Right now, you are seeing a lift, and it is interesting to see the nature of the lift. We are seeing it in a broad-based way with big banks and small banks both getting some reprieves from some of the comments that Janet Yellen put out there. We did hear some printed comments before she delivers them at 10 a.m. Just to give you a sense of one of the highlights. She says, our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion. The concern about medium-sized banks having some broader systematic kind of implication. We're seeing an 0.8%, almost 0.9% gain on the S&P. Yields higher, but not a lot of drama based on the tumultuous couple of days that we've had here. 3.56% on the 10-year. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. is studying ways to guarantee all bank deposits if the current crisis gets worse. That's a move sought by a coalition of banks. Bloomberg's learned the Treasury Department is looking into whether regulators have enough authority to temporarily insure deposits larger than the $250,000 limit without consent from Congress. PIMCO and Invesco are among the biggest holders of the Credit Suisse bonds that have been wiped out after the takeover by UBS. PIMCO holds about $807 million of the so-called additional Tier 1 bonds. Invesco has around $370 million of them. AT1 bonds offer attractive returns in good times, but takes the first hit when a bank runs into trouble. The Prime Minister of Japan is becoming the final leader from the group of 7 nations to visit Ukraine since the Russian invasion. Fumio Kishida is meeting with Ukraine's President Volodymyr Zelensky. Japan has sent non-lethal military equipment to the Ukrainian forces. It's also imposed sanctions on Russia. Bloomberg has learned that Vanguard has decided to close its remaining business in China. The U.S. asset management giant has notified Beijing it will shutter its unit in Shanghai, abandoning a $3.9 trillion fund market. It's also exiting a joint venture with Ant Group. Vanguard's peers such as BlackRock and Fidelity are still building up their Chinese operations. And rent increases in single-family homes in the U.S. slowed down for the 9th straight month in a row in January. That pushed the annual rate to the lowest since the spring of 2021. According to CoreLogic, the typical rent for a single-family home rose 5.7% from a year earlier. Orlando led the way with an 8.9% increase, followed by Charlotte, New York, and Boston. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rating World Cup.
This is a 3 as the economic picture does.
The OK is getting ready to make a decision.
We have a self-induced crisis by irresponsible fiscal monetary policy the last decade. I did not forecast the Silicon Bank issue, but I did have a view that we were heading to a crisis of some kind, and we've seen it.
That was Leon Cooperman, chair and CEO of Omega Family Office, who made his name over decades with single stock picking. And that's what he says we're going back to at a time when there is so much volatility, where he expects middling returns for the overall benchmark indexes, trying to parse through where we are now as we see a bit of a lift, a bit of a reprieve after days of some real angst, particularly in the bank stocks. Right now, we are joined by somebody with intimate knowledge through the cycles, as well as understanding how to play in some difficult moments. Dan Greenhouse, chief strategist at Solus Alternative Asset Management. How are you understanding, Dan, the bank distress that we've seen so far and how far it goes?
Well, listen, we're still in the early stages of this. I think it's pretty clear. We've got a couple of banks having already failed, another couple of teetering, but it's pretty clear that there are these, I don't want to use the word systemic, but there are these issues that are plaguing a number of banks that are going to result in a number of outcomes. It's going to be a compression in net interest margins as these banks have to pay up to attract deposits. It's going to be a decrease in loan growth, which, while not necessarily a substitute for rate hikes, is going to somewhat do the Fed's job for it in curtailing economic activity. It's going to be a higher regulatory burden on those mid-sized, but the 100 billion plus size banks. And it's probably going to mean consolidation in the sector as well. What it means for the economy at large is in my mind probably only going to be negative through that loan channel. I think there's a lot of people running around talking about how this isn't 2008 as if that's somehow okay. But while the issue itself is not at all arising to the 2008 levels, I think in an environment that is now characterized by elevated interest rates, what's happening in the banks isn't going to make things any better from an economic standpoint either.
You raise a really important point, Dan, and I don't think that this has been emphasized enough. People talk about what's going on as being a sort of temporary tightening, that they're going to pull back on some of their credit expansion, at least in the near term, as some of these banks decide how much they can count on deposits. But you're talking about a longer term consequence of less lending. Can you talk a little bit about which sectors of the economy that affects the most, which sectors of the economy these banks tend to dominate in when it comes to credit expansion?
Well, we know, and I'm certainly not the first one to say it, and I won't be the last, but we know that the commercial real estate market, which is already weak, is probably going to be weaker. A lot of the smaller and mid-sized banks do most of the lending. I forget the exact number, but even though smaller banks have only about 40% of the banking system's deposits, they represent about 50% of the total loan book for the economy as a whole. So they punch above their weight in that respect, certainly with relation to their deposits. And the first point you have to look at is the office market and the commercial real estate market. There's something going on in the cities right now that's going to have, it's going to take multiple quarters, if not multiple years, to fully play out as some of these leases reset. And you can see this in the public markets for those very large office REITs. They're telling you something is not right, and this type of a situation obviously doesn't aid that aspect of the economy at all. It's quite negative, to say the least.
What does something is not right mean when it comes to the trajectory of the economy in terms of when we see a recession, how deep it will be, what we look like on the other side?
Well, from an office standpoint specifically, we know that depending on which city we're talking about, the return to office, if you will, is running anywhere from 40 to 60%. There are some cities that are less, there are some cities that are more, but let's round and say that on balance in the office market across the country, and certainly in call it the 10, 20, or 30 largest markets, you only have about half of people back to work in any regular capacity at all. So that as those leases roll off, everyone's going to be dealing with the repercussions of what that means from a lending standpoint, from an occupancy standpoint, from a bank regulatory standpoint. That's that sector specifically. For the economy as a whole, I haven't done the work myself, so I'm not going to lie and say that I know exactly how it pans out. But the curtailment of loan activity, which is probably going to persist for several quarters now, is not going to take a weak economic or an increasingly weak economic environment and make it any better. The Fed, as we know, has interest rates at elevated levels. I don't think they should raise rates tomorrow, but neither do I think that is the end of the tightening cycle, because inflation is still running at quite elevated levels. And to repeat a point I've made numerous times, and it can't be said enough, yes, the year-over-year rate is coming down, but the month-over-month rate, either at the headline or at the core or super core, is at concerning levels from the Fed standpoint, and that's much more consequential for what the Fed should do. So even though in the immediate they may pause raising rates tomorrow, and I think ultimately that would be the right decision, when you're dealing with 0.4, 0.5, 0.6% readings on CPI, there's very little they can do in terms of easing to alleviate this crisis at all.
So your vantage point is coming from Solis, which is an alternative asset management company that oversees distressed debt opportunities as well as long opportunities. I'm curious where you're sort of seeing the most potential at a time when a lot of people are struggling to get their hands around exactly what the end result will be.
Well, I don't think the full ramifications of this episode has fully played out as of yet, and that's going to take a couple of quarters to do so. In what form and exactly what sectors, obviously, we'll be on guard for. In the meantime, I think there are plenty of opportunities for a fund like ours. I mean, obviously, you would like to see exponentially more distress, exponentially more defaults, which we don't have as of today. But there are still plenty of sectors of the economy that look attractive to us without weighing in at all about what we own or what we may be doing. There's the change in behavior in office I mentioned is something worth exploring. Who are the winners and losers there? On the content and the media distribution side of things, there's a change in behavior there that I don't think people are appreciating with what it means for the streaming services and the movie theaters and the vendors and those types of companies. In the travel and leisure space, hotel, cruises, skiing, and those sorts of sectors of the economy, there's a tremendous shift going on in consumer behavior. And so in each one of those sectors and others, there are clear winners and losers. on both the debt and the equity side of things. And our job is obviously to sift through them to find out where there are mispricings and exploit them. And again, even though we haven't seen the full ramifications of this episode, in the meantime, I think we're actually pretty busy. And I think there's plenty of stuff to be looking at and exploring.
In the aftermath of the great financial crisis, one of the most lucrative trades was Lehman claims. They were claims from Lehman Brothers after they collapsed, and the returns were pretty astronomical. I'm wondering, Dan, if there's an analog here with the AT1s, with the contingent capital bonds, maybe not from Credit Suisse, but from other banks that possibly don't look money good for a second, and then all of a sudden the regulators step in and say, actually, it's a pretty bad precedent to set. Is that something that looks like it has potential as other investors see this as uninvestable?
Well, if there's, as I'm now midlife in terms of my working career, I will say that the bad precedent to be set is set in every crisis, and never put it past lawmakers to set bad precedent and exploit these opportunities to quote unquote change the rules. With respect to the AT1 market, listen, that story is clearly unfolding. You can see in the performance of the various bank entities who has better language in their documents than others. I don't know that we're not traditionally a financial fund, so I don't want to say that we have any particular expertise in this, but clearly that market is going to be ripe for exploitation going forward. I think it's going to be at the outset, it looks like it's going to be very difficult for investors to not think that there is additional downside, to say the least, to those investments. And again, that's not a small market. That's 250, 270 billion, depending on how you measure it. And considering 16, 17 billion of them were just wiped out when people did not think that was what was going to happen, I think people are going to be taking a much closer look at the rest of that market.
Just real quick here, does it also change the investing landscape for all things Switzerland if they're willing to change the documents on something like this, or perhaps interpret it creatively?
Well, to get back to my other point, I wouldn't comment about Switzerland specifically, since that's no particular expertise of mine. But for governments as a whole, there's a very famous saying: if you don't like the law, get a new lawyer. And I think whether it was 2008 or the European debt crisis early in the 2010s, excuse me, or what's happening now, among others, lawmakers and policymakers and politicians have never failed to change the rules to suit their needs. And in some cases, that's the right course. In some cases, it's not. But I think everybody has to understand that in a crisis is likely to be the outcome.
Dan Greenhouse, thank you so much for being with us. Dan Greenhouse of Solus Alternative Asset Management, as we try to make sense of a market that has been anything but calm over the past couple of weeks. We have seen a round trip in the two-year yield, S&P, a lift this morning as we reassess some of the comments from officials. Coming up on Bloomberg Television and Radio at 12 p.m. Eastern, Kathy Wood, Chief Investment Officer at ARC Investment Management from New York. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
The Fed's two-day meeting starts right now, live from New York City this morning. Good morning, good morning. Equity futures positive, 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the U.S. studying ways to guarantee all bank deposits. J.P. Morgan putting together a plan to support First Republic as the Federal Reserve's two-day meeting begins in D.C. We begin with the big issue. It's over to you, Chair Powell.
I'm anxious to see what the Fed does.
We're facing a big Fed meeting this week.
Aiming both for price stability and for financial stability.
Whether the Fed tightens or not.
That's what he's got to get across, and it's not going to be easy.
You don't want to play around with banking crises.
It certainly has given the Fed reason to pause.
Taking a breather on the rate hike process is prudent.
Do they pause? Another question altogether.
The market is giving them 25 basis points.
Go to 25, wait and watch what happens.
They can't quite stare the inflation bear in the eyes and do nothing.
There is an opportunity there, we think, for the Fed to step in and really add a bit of confidence to this situation.
We say it every time that it's the most important Fed meeting. I think this one actually is.
Your team coverage begins right now with Bloomberg's Kelly Lyons alongside AMH down in D.C. Anne-Marie, first to you. Before we hear from Chairman Powell, we'll hear from the Treasury Secretary.
Yeah, that's right, Jonathan. We already got an excerpt of what she plans to say at this banking conference. One, she's going to defend the government actions. And then in the second point, she's going to potentially try to stem off any of that exodus we're seeing from some of these smaller, mid-sized banks into bigger banks when it comes to deposit. Here is the excerpt that she said. Our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. It's that similar actions, Jonathan, these kind of drastic actions the U.S. government took that she's saying they could step in again. Potentially a little bit of verbal intervention. I think what's so interesting about what the Treasury Department decided to release this excerpt before we have the market open. She's not expected to speak until an hour's time.
Kelly Lyons, First Republic, we're looking for a plan. What is the plan?
Well, that's an excellent question, John. There's perhaps the plan in the private sector and J.P. Morgan converting those $30 billion in deposits into a capital infusion. But there also is contingency planning happening within the U.S. authorities here in Washington and the Treasury Department studying how they may be able to expand FDIC deposit insurance to cover all deposits, not just those that are under that $250,000 limit. That would be in line with what mid-sized banks have asked for. A coalition of them wrote to the FDIC asking them to insure all deposits for 2 years earlier. But of course, over the weekend, but this is going to be a very difficult political question. For First Republic, though, you do see the stock up 26%. It may be because of that consideration on deposits covered that could help stop the flight of deposits we have seen from that bank to larger banks potentially, or because it's JP Morgan CEO Jamie Dimon trying to attempt another rescue of that bank. John.
Katie, have you got a sense as to why this bank is so important to these big banks on Wall Street?
Well, I think it was forced importance because we did have Treasury Secretary Yellen personally meeting with Jamie Dimon here in Washington about this issue last week. But I think it is about stemming the broader confidence crisis that we have seen in the banking system. No bank probably wants to see this kind of deposit flight and turmoil within the banking sector. And given that the government had already stepped in to make depositors whole in Silicon Valley Bank and Signature Bank, there was a lot of concern about that being framed as a bailout. It raises the question of the ability to repeat that, so maybe banks themselves are trying to stem the bleeding here as well. But it is a very valid question, John, considering this is not a bank that, at least before 2 weeks ago, was considered too big to fail. I guess there's a question now of if any bank is going to be allowed to fail going forward.
MH, that question to you as well. I think we need to talk about this. All of a sudden, First Republic becomes this big deal for big banks on Wall Street. Anne-Marie, why?
Well, I think one of the reasons is that they don't want this, as Kaylee said, to stem to any other banks. If it's First Republic and then that one fails, what other banks potentially could then fail? And if you have to stop the bleeding somewhere. So they obviously saw something with this bank that they all felt the need. 11 banks, remember, felt the need to step in and shore it up to make sure that this would not spread from that bank to the other. Clearly, this is a bigger concern, not just for bank CEOs. Yes, Jamie Dimon was here speaking with Treasury Secretary Janet Yellen last week, but writ large, the U.S. government obviously is concerned. They don't want to see any other banks in the situation First Republic's in.
AMH, you've got to tell the guy next to you just to stop while you're talking. Well, you've got to shout. AMH, down in Washington, thank you. Alongside Kelly Lyons as well. First Republic today. We've got a bounce. We're up by 27%. Let's get to Exonic's Peter Cicchini, Matt Miskin of JH Investments. Matt, what do you think of this line from Secretary Yellen this morning? Good morning to you both. Our intervention was necessary to protect the broader U.S. banking system, and similar actions could be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. Is that sufficient for you, Matt? Are those words enough?
I would just be careful writing a check you can't cash. In that what she's implying, that's a lot of money. I mean, we're talking trillions of dollars potentially of backing all the banks. And that's a totally different playing field, too. That's a change to the banking system overall, because if you do say that the FDIC has all deposits, they're going to have to pay more. And that's going to lower margins. And right now, what you're seeing is you've got this shock and awe and volatility in the banking system right now in terms of the stocks that are playing this. Is it a bankruptcy? Is it not? A solvency risk trade. But then you've got a longer term issue of, are the profit margins going to be there? Net interest margins going to be there? Lower interest rate environment. And that likely to us is going to weigh on the banks. We see financials right now still pretty expensive at 1.3 times book. You know, we'd be interested maybe around book value. But for now, we're still a bit cautious, even though they are running this morning.
Pete, are you on the same page?
Yeah, I agree with Matt on that, you know, but job one right now is restoration of confidence. So I'm not sure they're actually worried about, you know, whether or not they're able to cash that check, as he said, because they believe they can. You know, part of the problem here, though, is the moral hazard this creates, and it has not been discussed very much at all. And I think the reason for that is because we know a few things. Fractional reserve banking systems are fragile by their very nature. And so we're all asking, why is First Republic so important? Well, it is a fractional reserve banking system. And even a small butterfly flapping its wings in a distant place can affect the entire system because of the leverage embedded and inherent in the system. Importantly as well is the fact that the bank lending channel is absolutely paramount to growth. And when that is impaired, which it will be now, right, because net interest margins are going to compress as banks have to pay more to attract depositors in an already inverted yield curve environment, alongside the fact that lending standards will invariably go up in an environment where lending standards were already tightening. I think that's why The Treasury and the Fed have invoked Section 13.3 again with their lending facility, and they're doing everything they can to restore confidence, because once confidence is gone, it's much harder to get back.
Pete, let's unpack some of that. Your first point, we're like this far away from totally transforming the banking system in this country. And Pete, to your point, we need to give it a whole lot more thought. How do you think that could change, that move alone, just to ensure all deposits, even if it's just for a couple of years, to go in that direction again? Where would that leave banking, and where would it leave investment opportunities for you?
Well, let's just think about it from a social perspective to start. It comes very close to the socialization of the banking system and the socialization of risk at private banks. And I think that's incredibly dangerous, because once that happens and private actors within markets can no longer bear the risk of their behavior, that is to say, they can lend and know that for whatever reason, if things go south, that their depositors will stay with them. That's extremely problematic, I think, for capital markets in general and for a capitalist society. And whether or not Treasury and the Fed think they can team up to do such a thing, that is to ensure all deposits, I think Congress ought to take a pretty close look at that before that actually happens.
Marko Kolanovic says already that we're at the point of no return. The Fed has gone past that point. This is what he had to say in his note this week. He said the Fed is facing a difficult task. It is likely already past the point of no return. A soft landing now looks unlikely, with the airplane at a tailspin, a lack of market confidence, engines about to turn off, bank lending. Matt, do you see it that way? Have we gone past the point of no return, considering 2 weeks ago we were talking about 50 basis point hikes in a boom economy?
Yeah, John, when the 2-year Treasury yield starts acting like a meme stock, we've got some problems. And really, I know you tweeted about this morning, but, it's been 2-year yield went much higher after the last Fed meeting and then plummeted. When the 2-year yield usually plummets below the Fed funds rate, if you look back over the last 50 years, that's a sign the Fed is going to be pausing and then cutting in the not-so-distant future. And even though the 2-year yield has been making up some of the ground it lost, last week it was down 77 basis points in a week. That is the biggest weekly decline in over 30 years.
Yeah.
And that just, to me, that's a signal that that's really where the direction of the Fed is going to be going. I know it's incredibly volatile, but when the 2-year yield is well below the Fed funds rate, and to me, I think they go 25 basis points. I think they put it at 5. They say, look, look back on history. We went to 5% with high inflation. But then, the bond market is pricing in already a cut at basically the next, they have a May rate hike priced in as well, but then a cut in June, and then 2 more cuts after that. So the bond market's saying, yeah, you're going to raise rates, but it's going to be a mistake, and you're going to be cutting in not so distant future.
Look at this trip. Let's stay on that chart. February 1st, that was when the Federal Reserve met. That was a Wednesday. And the 2-year yield then at the close was 4.1%. We went as high as 5.08%, something like that. And look at this, back to where we started again at 4.1%. We've hardly moved, nothing's happened if you've been on a rock for like 2 months. Pete, the Federal Reserve, you heard Matt then, they're going 25, but ultimately this market's screaming they're done, and a lot of people think they're done. Do you agree? Do you think they're done?
Yeah, I'd have to agree with Matt. Again, one of the things that we like to look at here is the swaption volatility surface, and specifically what does 2-year versus 10-year swaption volatility look like. And when that inverts, that screams that the Fed is at some point going to be in need of a cut. It also screams that equity market volatility is wildly dislocated. I think it's also important to recognize the Fed has recently reiterated the fact that it has different tools for different kinds of problems. Probably one of the reasons it's been so aggressive in using the financial stability tools specifically. So I do agree we get 25 basis points, but it will be bathed in more dovish language than it has heretofore. But the Fed remains data dependent. So we get the hike, it'll be dovish. But I still believe that even if the Fed starts to cut, if history is any guide, going into a recession, which I believe is unavoidable at this point, equity markets will have to correct much further, and that often happens as the Fed is cutting.
We'll come back to those comments in just a moment. Peter Cicchini, Matt Miskin sticking with us. Equity futures right now near session highs of 0.9% with some movers going into the opening bout. Here's Abby.
And a big piece of the rally, John, of course, is the bounce in banks that we're seeing you and Kayleigh talking about, in particular for the regionals and First Republic. Those shares up the last time I looked. Right now at session highs up 28% as investors are today focusing on the $30 billion lifeline, plus that possibility that you all were talking about, unlimited deposit guarantees. I would caution, though, this stock was up 26% on the close last Tuesday and then fell precipitously, so volatility is the name of the game. Bank of America and other big banks up sharply, and this, of course, as yields are backing up in a big way. That, of course, helps the lending business. Tesla up 2.6%. They're now a blue chip rated company, no longer junk. Moody's has joined S&P in making them IG, and BI is saying that this is a real game changer, historic event. And then finally, Carnival up 3.25%. Deutsche Bank is saying you want to buy this stock ahead of earnings on the 27th. So we have a broad-based rally this morning, John.
Abby, thanks for that. Coming up on this program, waiting for the Fed's next move.
I think we know they're not going to raise 50. I think we know they're not going to cut rates. The real question is 0 or 25.
That's the question we'll try to answer up next.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends, we're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think we know they're not going to raise 50. I think we know they're not going to cut rates. The real question is 0 or 25. The case for 0 is do no harm. We know that the banking system's under stress. The case for 25 basis points is to say, look, we still have an inflation problem. We can do both. We can use our liquidity facilities to shore up the confidence in the banking system, and we use monetary policy to bring down inflation.
Last time we heard from Fed Chair Jay Powell, he opened the door to 50 basis points. That was 2 weeks ago. Wall Street now taking sides on whether they make a move at all on Wednesday. Goldman, Wells, Barclays, they say the Fed is hitting pause. On the other side, looking for the Fed to stay the course with a 25 basis point increase, Morgan Stanley, Citi, Bank of America. For more, let's bring in Bloomberg's Mike McKee. Morning, Mike.
Morning, John. Well, that was the screen door, not the main door. And Jay Powell is not going to be opening the main door to 50 basis points this time. It has been a crazy couple of weeks. Remember when Jay Powell went up to Capitol Hill and said, well, if the economy calls for it, we'll raise 50 basis points. You can see what that did to expectations for this meeting. And then they plunged on the Silicon Valley Bank news and have sort of bounced around with the stock prices of regional banks. Right now, the green arrow is kind of pointing to where they would be if they went 25 basis points. The white line is where the market is. So the market's sort of coming to that level. They haven't gotten complete conviction yet that the Fed's going to do that, but there is a belief that maybe inflation is the issue. I think that Bill Dudley put it very, very well. Can't improve on that. Powell's problem is you got PCE inflation still at 5.4%. That's way above their 2% target. And GDP is not really slowing. Atlanta Fed GDP now, latest number, 3.2% for the first quarter. So his choice is pause tightening tomorrow, promise more later. That would be a hawkish hold, or raise 25 tomorrow and promise to be vigilant. That would be something of a dovish raise. The questions that he's going to face are going to be very interesting. What's the economic outlook? We'll get the dot plot tomorrow. We'll get their summary of economic projections. What do they think is going to happen to inflation, unemployment, and to growth? The state of the nation's banks, there will be a lot of questions about that. And of course, he will be asked, how did you guys miss Silicon Valley Bank? John?
He's going to face that question a few times, I imagine, Mike. Mike McKee is going to be there. Looking forward to Mike's coverage throughout the whole of tomorrow. This question's been asked a million times in the last week. Is there a policy conflict right now between targeting inflation and targeting doing something about financial instability? This was Seth Carpenter at Morgan Stanley. This is what he had to say. The current market volatility has the potential to tighten financial conditions and hurt economic growth. So if a central bank refrains from hiking, it is not a focus on financial stability at the expense of macroeconomic objectives. Matt Lazzetti of Deutsche Bank went one further too. We ultimately believe the recent shock is likely to tighten financial conditions in a way that has brought sufficiently restrictive into closer view. Matt, do you agree with that take, that these two things aren't necessarily in conflict?
Yeah, I mean, financial conditions are a tough one. And there's a great article out this morning that's financial conditions are, very subjective, very hard to pin down. I mean, high yield spreads are 500 basis points. That's not that wide. That's right in line with its 20-year average. The dollar's been weakening. If the dollar was strengthening, that would be more of a risk-off environment. But what you're seeing here is that I think the markets have actually handled this relatively well. And actually equities are coming back a little bit. So we try not to use financial conditions because they're so quick to move, and they really, I think if the Fed over relies on financial conditions, it's just going to get whipsawed, and they're already getting whipsawed. I'm picturing John sitting around the table at the FOMC doing the summary of economic projections, and everybody just going down and writing numbers with just because it's so hard, and you gotta understand that, you gotta respect that. It's a challenging job right now. But I think for them, staying on the course with inflation, making sure that they're being, I'd say, a hawkish one rate hike and hold would be the best outcome given everything that's going on.
Matt, I'm totally with you. They might as well get the darts out, hand them round, and just start throwing them. The problem with this, Pete, is they have to do something. Don't necessarily have to do something, of course. They could just trash it and not put out anything at all. But, Pete, if they do, it's not about where they truly believe things are going to go. Pete, it's about what they want to signal tomorrow and how they use the dots to do that. How do you expect them to do that?
Yeah, no, I completely agree with that, and appreciated Matt's comments. The way they do it is going to be incredibly important. And if we take a half a step back and we say, why are we having this banking malaise at the moment? Well, one of the reasons is inflation. I mean, it's much more complex than that, but it is the inflation on the heels of many years of very low rates. So we had banks risking on, so their asset quality deteriorated. You had tremendous volatility in deposits. That was the outgrowth of fiscal policy measures during the pandemic. We went from a glut in deposits to now a dearth of deposits somehow within days. Very, very odd. But the idea here is that inflation is also at the core of this, because the assets on bank balance sheets, which had been held to maturity, once they went held for sale and actually needed to be sold, were worth much less. So if the Fed lets inflation continue to progress or remain where it is, and rates have to go up even more later, that could exacerbate the banking problem. And so at the end of the day, I think the Fed has to bifurcate the problems, even though they're inextricably intertwined. The Fed has to continue to deal with inflation. I think they go 25. I think they say we stay data dependent, but certainly it's going to feel a lot less hawkish than it did last time. But equities, if you think about the way equities are interpreting this versus Fed fund futures, are expecting something incredibly dovish, in my view, not an 80% chance of 25, which is what Fed funds are giving us. So I think 25, even with dovish positioning, could be negative for equity markets.
Matt, I'm not sure if hikes are bullish, bearish. I've got no idea anymore, given the signaling you could get in the news conference. Matt, what are you looking for? And ultimately, where do you want to be positioned going into this one?
Yeah, John, I think you got a good point, because the ECB last week went with 50 basis points, and that actually added confidence, because they said if the ECB hadn't raised rates at all, there would have been signal of worse outcomes for the banking system. So I do think they have to be confident. I think they have to go with 25 to ensure that they're saying, yeah, the economy is still strong enough for us to do this. Yeah, so in for positioning wise, we're looking at the quality factor. We really think balance sheet strength is going to be the number one work to do in terms of equity analysis here. On the bond side, I get the volatility. It's been very choppy. On the 10-year, 340 has been basically impossible to get through, but we're sticking with our high-quality intermediate bond call to ride out this volatility.
Hey, Matt, there's tons of that, that's for sure. Tons of volatility. Matt Miskin, Peter Cicchini, thank you. Coming up, the morning calls in later, the case for 25. Cameron Dawson of New Edge Wealth.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
With a lift here, let's get you some morning calls. First up, Morgan Stanley upgrading Harley-Davidson to overweight, highlighting effective restructuring strategy and attractive valuation. Stifel resuming coverage of Alphabet, 130 price target with a buy. The analyst saying the AI competition concerns are overdone. And finally, Morgan Stanley, its price target for Meta goes to 250, calling it the most durable mega cap with better cost-cutting measures than its peers. That stock is up by 2.9%. Up next on this program, Cameron Dawson of New Edge Wealth, betting on the Fed to raise 25 basis points tomorrow.
very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
About 25 seconds away from the opening bow this morning. Good morning. Equity futures with a lift up 0.9% on the S&P. The bank's doing better in the pre-market. First Republic with a real bounce a little bit earlier this morning. On the Nasdaq 100, up 0.7% on the session. On the year, absolutely flying. Let's the opening bow, switch to the board and get to the bond market. Yields look a little something like this on a 10-year, higher by 8 basis points, 356.57 on a 2-year yield. Even higher than that this morning. On the 2-year Treasury in America, we're higher by 16 basis points to 4.14%. Mentioned this earlier. If you're just tuning in, welcome. When the Fed last met on Wednesday, February 1, we closed that day at 4.1%. This 2 year's been all over the place. It's back to about 4.1% after being north of 5, then south of 4. And now back to 4.14. In the FX market, euro dollar positive 0.6%. Stronger euro for 4 straight sessions now, 107.86. And crude still below 70, 68.75, but positive on the day by 1.6%. 40 seconds in, we're positive 1% on the S&P 500. On the Nasdaq, up 0.9%. The one stock to watch at the moment, First Republic, shares trying to stage a comeback after record losses. The stock topping the S&P 500's worst performers at the close yesterday. Now it's taking JP Morgan's latest support efforts in stride. Kelly Lyons has more. Hey, Kelly.
Yeah, massive 30% move to the upside at the opening bell today, John, which would make this the 8th in 9 trading days that this stock has moved 15% or more in either direction. The one day it didn't, it was a 10% move. So that just goes to show you the kind of volatility that is surrounding this name at the moment. But as you say, the move this morning is to the upside. And maybe we can blame a lot of that on JP Morgan CEO Jamie Dimon, who is reportedly, according to Bloomberg sources, orchestrating a plan to convert some of that $30 billion in deposits JP Morgan and 10 other large banks gave to First Republic last week into a capital infusion. The question is, does this do enough to support the bank? Because remember, we had S&P Global Ratings downgrading the credit rating of First Republic twice in the span of less than a week because they said that $30 billion in deposits is not a long-term solution. I also would note that this stock dropped 47% in yesterday's session, even after we already had the reporting around this potential plan from Jamie Dimon and co. So it raises the question of how much the move today is really about that versus maybe reporting from Bloomberg that the FDIC is looking to extend deposit insurance to cover all deposits in the banking system in theory. All this said, looking at this move today, John, which yes is massive, it only goes so far to unwind the damage that has been done to this stock over the last 12 trading days or so. This is still a stock that has lost more than 3/4 of its value over that time, John.
Brutal, triple-digit stock. only 2 weeks ago. Katie, thank you for that. The bank's doing okay today, better than okay. The financials on the S&P 500, the best performing sector, the financials up by 1.9%, the S&P 500 advancing 1 full percentage point. The broader sector doing okay. Regional banks looking to post a second day of gains after the index hit its lowest level in 2 years. Abby has more. Hey, Abby.
Hey, John. Yeah, it's a real relief rally here today for the banks and the regional banks in particular. As you were just mentioning, the KRE, that regional banking spider, it's up 4.9%. And over the last 9 sessions, 6 of those sessions, we've seen moves of greater than 3% up or down. This is the best day going back to January of 2021, so almost in more than 2 years. So that's the degree of the rallying at this point. And New York Bank, Community Bank Corp up in a big way, PacWest as well. Beyond the relief, beyond the possibility of an unlimited backstop, take a look at this 2-year yield that you've been talking about. I mean, this is just incredible, up 32 basis points over the last 2 days, normalizing to some degree back above 4%. And it's not helping just the regional banks, but the big banks too. If you were to chart the 2-year yield over the last 2 days in the XLF, a broader look at the banks, you would see them basically moving in tandem, because today on the session, we also have JP Morgan, Bank of America, Citigroup, Wells Fargo, all of these banks trading higher. I think that the yield's climbing. That's a big piece of the story this morning, John.
Abby, thanks for that. Let's throw another name in there, New York Community Bank Corp. Let's take a look at that right now. D.A. Davidson upgrading the stock to a buy. It's positive 6%. The analyst Peter Winter citing the deal to acquire Signature Bank's deposits as attractively valued and, quote, a transformation to a more commercial bank-like structure. The stock is up by 5.6%. These names have been all over this place, including UBS, which has equally been all over the place over the last week. UBS right now up by 7% in Swiss trading to 1860. Bloomberg's Jan Patrick Barnett joins us now from Frankfurt. Jan Patrick, there was a worry 24 hours ago when that name opened up that maybe they'd taken on and created perhaps a monster. What's the mood like in Switzerland now?
Well, I think like the mood is sinking in that this is a positive deal for UBS, and the stock is continuing the rally after we saw this monster turnaround yesterday with the stock dropping as much as 15% before it turned around and closed actually higher. So everybody, I think, is agreeing that the terms are very generous. It's government-backed. There's a loss absorbing buffer for UBS there. Of course, there are risks to the execution. It might not be a mega merger in terms of market value, but it is still a mega merger in terms of operations. And UBS has probably to stem some costs first before all the benefits will float in. But overall, I would say like everybody is pretty happy now in European banking land for the moment with an immediate crisis avoided and that we are seeing in the stock prices today.
Jan Patrick, we'll catch up with you, sir, in about 10 minutes. A lot more to talk about with Credit Suisse and UBS too. The broader equity market 5 minutes into the session, positive by a little more than 1% on the NASDAQ, up by a little more than 1% as well. Cameron Dawson of New Edge Wealth laying out her expectations for the Fed meeting this week and writing the following. We expect 25 basis points, but for the Fed to follow a similar path as the ECB, emphasizing data dependence so they don't have to commit to further hikes. Cameron, I'm pleased to say, joins us right now. Cameron, can we just start with a move in a 2-year? And welcome to the program. This 2-year, since the Fed last met, has been all over the place. What do you make of it?
It is really unprecedented, the kind of moves we've been seeing. I think we do have to ask the question how much positioning could be impacting the 2-year as well. We have seen record short positioning in some of the futures data, which could be adding to some of this volatility. But the 2-year really is a reflection of how much risk this market wants to take. With the 2-year moving sharply lower, that's typically consistent with the bond market betting that the Fed is going to have to engage in very rapid interest rate cuts, simply because there is economic weakness on the horizon. So if we see the 2-year continue to break down, it really would raise the question of how much equity or risk asset resilience we could continue to see if we are going to see much more economic weakness.
Cameron, the last time you and I spoke, you said it. It's not the inversion you need to fear, it's the bull steepener. We've had a monster bull steepener. Typically when that happens, where do you want to avoid in the equity market? Where do you want to be?
Well, you typically want to avoid cyclicals and riskier parts of the market, and you want to be in defensives. And it's interesting because despite some of the rebound we saw in certain parts of the market last week, we did see a slight tone or shift away from cyclicals into more defensive parts of the market. So very quietly, you started seeing things like staples outperform the consumer discretionary stocks, or industrials and materials really breaking down last week. So that could suggest that maybe that cyclical trade that really colored markets since the October lows is behind us, and that would be consistent with a bull steepener, which is reflecting greater economic weakness on the horizon.
There are people who want to play the recovery off the back of a rate-cutting cycle. They want to play the recovery before we see the recession. Cameron, BlackRock came out with this. They say, we stay underweight equities, downgrade credit, prefer short-term government bonds. We don't see central banks coming to the rescue with rate cuts, but using other tools to ensure financial stability. The Fed is going to hike this week. Now, Cameron, a few months ago, a lot of people said the same thing. The Feds are not going to save you. It's not going to save you. And here we are, a few bumps in the road, a couple of bank failures later, and all of a sudden it's rate cuts. The bank's going to save, the Federal Reserve's going to save you, get long the NASDAQ. What do you say back to them?
Well, the Fed has a huge inflation-sized pickle in this, which is that every other time that they have come in to support financial markets, the reality has been is that inflation has been at or below their target, meaning it's below 2% on the core PCE, and that's simply not the case anymore. So we've talked a lot about how the Fed doesn't want to be Arthur Burns with that stop-go policy of cutting rates and hiking rates, and that really cemented inflation of the 70s. But we also have to ask the question, does the Fed not want to be Alan Greenspan? Do they not want to cut rates by 100 basis points like they did in 1998 in the face of LTCM and effectively create an asset bubble which could exacerbate inflation in our current environment? So we think that it's far more of a tough decision of a catch-22 than at any other time really since the early 90s.
I've been quoting Dario Perkins from TS Lombard all morning, who tweeted a little bit earlier on this morning that central banks are stuck between the ghosts of the 1970s and their PTSD from 2008. Cameron, he said he thinks that PTSD wins out. Cameron, what do you think wins out?
Well, I think that things would have to get worse before they get better. We'd have to see far more systemic banking issues for the Fed to completely put its inflation-fighting mandate on the back burner. The reality is that the real economy, real economic data that we're seeing today still suggests that they should be fighting inflation and raising rates. However, the financial economy is showing enough weaknesses that in the past, if inflation wasn't an issue, that they would be at least pausing or cutting. So we think given the fact that now they have these two masters to serve, you effectively have to see even more weakness really reveal itself within the banking sector before they would completely ignore the inflation fight, because they've told us many times inflation creates financial instability itself, which they do want to avoid.
Cameron, I see all these estimates about the financial instability of the last couple of weeks and how it equates to perhaps Federal Reserve tightening. This came from Goldman and the team led by Jan Hatzius. They said that this could be the equivalent of 25 to 50 basis points of Fed rate hikes. Cameron, is it too early to make that conclusion?
It all depends on the path of loan growth. One of the most interesting things in 2022 is that we saw loan growth continue to run at a high single-digit clip all year. That's despite the fact that the Fed was rapidly raising rates, and you saw those senior loan officer surveys talk about tightening lending conditions, yet loan growth chugged along. So is this the situation? Is this regional banking issue the spark that gets loan growth to finally roll over, which really would be that tightening of financial conditions that would work its way through the real economy? And so we have to watch this closely, but loan growth is a famously lagging indicator as well, and it could move slowly. So we'll watch small bank loan growth the closest. Large banks had already moderated their loan growth quite a bit. Small banks still running in that high single digits. If that rolls over, that's the sign that this is kind of doing the Fed's tightening for it.
Hey, Cameron, a lot of people tuning in today, and I think they've all got similar thoughts about the psychology of this meeting. One tweet that I received in the last hour: I believe the market will sell off if the Fed does nothing tomorrow or gets spooked thinking that the banking industry is worse than it is. 25 basis points is the best they can do. Do you believe there is that sense, Cameron, going into this news conference that Chairman Powell somehow knows something that we don't?
Yeah, it's the question of what lies beneath. And if they do nothing, do they see something that we don't see? Now, that's also giving the Fed a lot of credit to see into the banking system. Don't forget that Powell talked at one of his most hawkish testimonies just a couple of days before the SVB issue. The question is, do they have even greater visibility now that would suggest that there is something much bigger, something much more systemic at work here, and that they need to pause and they need to take more aggressive action to be accommodative? I think that's what the market would take if they decided to do nothing, and if we see in that dot plot more interest rate cuts or a lower terminal rate, that could be another signal that they see something that we don't.
Well, we've got a bounce right now. Cameron, thank you. Cameron Dawson at New Edge Wealth. We've got a bounce in this equity market at more than 1% on the S&P 500. On the NASDAQ, positive by a little more than 1% in the bond market. Treasuries selling off, yields rising by almost 20 basis points on a 2-year, 4.17%. That's a big move at the front end of the curve. I know what you're thinking. We've had monster moves over the last couple of months, but that's still a big move, up by 19 basis points on a 2-year. Coming up on this program, investors still feeling the fallout from UBS's takeover of Credit Suisse.
Regulators have moved very quickly with the UBS situation. That's a good thing. But at the same time, we've had some surprises, such as the AT1 bonds being written down ahead of equity holders.
That conversation up next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
So now,
entire journey.
The moment news breaks, no one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
Regulators have moved very quickly with the UBS situation. That's a good thing. But at the same time, we've had some surprises, such as the AT1 bonds being written down ahead of equity holders. So, investors have to kind of understand that, in a crisis, sort of anything can happen.
The fallout of UBS's takeover of Credit Suisse, S&P and Moody's lowering their outlook on UBS to negative from stable, writing the following: we see material execution risk in UBS's integration of Credit Suisse, the deal wiping out Credit Suisse's AT1 bonds. PIMCO facing up to $807 million in losses. Invesco, that number could be 370. Your team coverage starts right now with Bloomberg's Jan-Patrick Barnett in Frankfurt, alongside Shanali Basak here in New York. Shanali, this has been a controversial 24 hours.
It certainly has been, because we know that the prospectuses say one thing, and now we know the central banks of the different regions are coming out to protect bondholders as well. That can quickly become equity holders, as we've seen in the case of Credit Suisse and UBS. Now, I want to point out a really interesting statistic, John, that we've heard from our team. The analysis shows that UBS actually has the highest amount of additional Tier 1 capital here as a percentage of its highest forms of regulatory capital, that is CET1. And so there are questions here about even UBS's own exposure to this form of debt after we saw the wipeout over at Credit Suisse. Now, what these investors will do after being wiped out. You mentioned PIMCO, Invesco. Add BlackRock in there to the tune of more than $100 million, plus many other bondholders here that thought these bonds were plain vanilla, just about. They did not factor in this form of risk. What next? That's the big question. Remember, PIMCO, of course, is a $1.7 trillion asset manager. It's short in the scope of that. But again, this was a way that they engaged significantly in the European banking system. Will that be as attractive of an outcome moving forward, especially for banks like UBS and Barclays, frankly, that have so much of this capital as a percentage of their CET1?
John Patrick, there's a lot of unhappy people about this issue, particularly in the last 24, 48 hours. But this isn't the only issue that is drawing controversy. It is also the fact there will be no shareholder vote. Now, John Patrick, I read the FT piece, and it was a fantastic piece about the story of the weekend. And I keep returning to this quote. They cite one person close to one of the three major shareholders, and this was the quote: "You make fun of dictatorships, and then you can change the law over the weekend. What's the difference between Saudi Arabia and Switzerland now? It's really bad." John Patrick, what changed for Swiss banking over the weekend?
Well, I mean, like it's a question for the European banking sector. I would say the same for the bond issue, that we now have a case of a first precedent in like really harsh measures towards the shareholders and the bondholders. And you can debate this, if this was necessary or not, in how much trouble Credit Suisse actually was, and if like such a hasty decision was warranted. The fact that they took it tells me that there was some sign to them that they were fearing a wider contagion and a bigger issue for the European banking sector, and they've said to themselves probably like, let's take that step and just secure the whole system, and then we deal with the fallout later. But overall, the question will be if like, have they ruined the European banking sector on the bond side and on the equity side for quite a while, and only time will tell how investors will like digest this, and if they come back to the European banking sector with the confidence that this was a one-off and not the rule.
Bank investors learn things. I think JP Morgan learned from their experience acquiring banks in a financial crisis and then inheriting the regulatory and legal risk associated with that. UBS, I don't think it's a surprise that they got the government guarantee over the weekend. I wonder if Middle Eastern investors will learn from this as well. Jan Patrick, the next time a European bank or Swiss bank gets into trouble, how reluctant do you think that pool of capital is going to be this time around?
Well, they will definitely be a little bit more reluctant than they have been previously, and they will probably like not do those risky again, because like I think the Saudis knew that putting a lot of money into Credit Suisse is kind of a gamble. Of course, but the bank had some prospectus and some idea of a turnaround plan, but you never know. Banking execution can be quite tough, and Credit Suisse didn't have a great track record to do so. So if they wouldn't knew about the risk, I'm sure that's something you have to consider when you invest into banks at all time. So is this market burned? Maybe for now, yes, I would say so. But the long run, I'm sure, like if there's an interesting and a compelling equity story, then investors will be very happy to come back into European banking shares.
You won't hear much about European banks today because the stocks are up. European bank stocks are up by 4.8%. No real drama there right now. Jan Patrick, Shanali, to the both of you, thank you. Your broader equity market about 22 minutes into the session, positive, almost 1% on the S&P. On the Nasdaq, up 0.9% with some sector price action. Here's Abby.
It's interesting, John, because today we're looking at some classic sector action. Energy is the top sector on the morning, up 2.7% in line with oil. And then we have the financials up sharply, too, up 2.1% as yields climb. And on the relief rally for the regionals, in the middle, we have some of the tech, material, industrials. And then on bottom, all of your high dividend yielding stocks, those interest rate sensitive stocks, those sectors are underperforming. Utilities and consumer staples both down, real estate and healthcare also underperforming. On the year, though, this is the story. It's extraordinary. You have communication services, so basically your Twitters, your Googles, Amazons, sharply higher, up 16%. Tech also up about the same amount. The regional banks, on the other hand, plunging, down 22%, on pace for the worst year since 2009. The bigger banks also, broader banks also down about 7%. Quite a divergence that we're seeing so far this year, and we're only a few months in, John.
Abby, thanks for that. Looking forward to the coverage tomorrow. The Federal Reserve coming up. Looking at your market right now, about 23 minutes into the session. Equities on the S&P up by 1%. Your trading diary up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
25 minutes into the session, equities higher by 1% on the S&P, on the Nasdaq up by 0.9%. Big moves in the bond market as well. If we switch up the board, 2s, 10s, 30s, yields up at the front end in a major way, up 19 basis points to about 4.16, 4.17%. That's the price action. Let's get to the trading diary. Existing home sales at the top of the hour. The Fed kicking off its two-day meeting, the main event on Wednesday, an FOMC rate decision, followed by Chairman Powell news conference. Secretary Yellen heading back to Capitol Hill. You'll hear from her a few times this week. Rate decision from the BOE, the Swiss National Bank, that comes on Thursday, alongside another round of jobless claims. And rounding out the week with US durable goods and PMIs. Before we get there, we've got this. Let's get the promo up. The Fed decides. You're going to catch up with Richard Clarida, Priya Misra, Diane Swonk, Bill Dudley, and more. Fantastic lineup for you throughout the whole of tomorrow on Bloomberg Television. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
The top names in business are on Bloomberg.
AI is real. We're already using it to do risk, fraud, marketing, prospecting, and it's the tip of the iceberg. This is extraordinary. And the other thing to keep in mind, there's good use, but bad guys are going to use it too. So it's a little bit of an arms race in how you have to use it to protect your company, protect your clients, protect data, et cetera. And we're fully engaged.
Nobody covers business like Bloomberg, your global business authority.
Britain's next.
Was going to keep bringing World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets, So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some passed the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent
and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind. But it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as you're going to describe about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools.
Wow.
So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park. And inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planted terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20–25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy, Austin John Plays. This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the, like, profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that these people, this sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him there's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long, and as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Ina co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station.
This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Ina and her team are working on another 100-kilowatt project at the Port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of
Machiavellian companies where, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He's making you, but you act from this side. I mean, it's corrupt.
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in this for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to a jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
Yeah, it's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered, for me, the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Ghosn Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This is a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day, she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollars trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil is going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they've done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.